Welcome back to the Deep Dive. Today, we're focusing on Cavco Industries, CVCO, and really digging into their latest earnings call, Q2 fiscal 26.
Yeah.
The headline results, they looked really impressive, a big beat on earnings.
Huge beat.
But the real question for you listening is how? How did they pull off such strong operational performance, profitability, right when parts of their main housing market seem to be hitting the brakes?
Yeah, that's the tension, isn't it? And that's why we need to unpack this. The market reacted positively, sure. Saw the headline beat.
Stock popped.
Exactly. But we need to figure out what really drove that growth. Was it just like a good quarter, maybe some luck, or is something fundamentally changing in how they make money? That's what we're after today.
Okay, let's start at the top then, the numbers. Because the beat was significant. Diluted EPS was at $6.55.
It's at $6.55, which is, get this, a 24% jump year over year.
Really strong.
And revenue. Revenue was solid too, $556.5 million. That's up 9.7% from last year. Also beat expectations. But like you said, the profit story is even better.
Yeah, that operating profit number. Up 26.6% year over year to $62.2 million.
Right. And whenever you see profit growing, that much faster than revenue, that's your signal. You've got to look under the hood at the margins. Something interesting is happening there.
Okay, so margins. Consolidated gross margin expanded, but only by 130 basis points to 24.2%.
Doesn't sound like a revolution on its own, does it? 1.3 percentage points.
No, but when you break it down, the core business margins, the factory-built housing part, they were basically flat, right?
Precisely. That's the key nuance here.
Yeah.
Factory-built housing gross margins stayed right around 22.9%, flat. And management was clear they didn't really push pricing this quarter. Wholesale prices were, essentially unchanged.
Wait a minute. So if they didn't raise prices, how did the average selling price, the ASP, go up? Because it did go up.
Ah, good question. That increase, and this shows some smart management, was all about the mix. Two things drove it.
Okay.
First, they sold a higher percentage of homes through their own retail centers.
Yeah.
Company-owned retail. That just pulls more revenue through per unit.
Right, makes sense. And second?
Second, they sold more multi-section homes. Bigger, more complex, higher price tag homes. So it wasn't about charging more for the same thing. It was about selling a richer mix, execution.
Got it. So if the core factory business margins were flat, we need to talk about financial services, the FS segment.
Oh, yeah.
This is their insurance and lending support arm, right, for manufactured home buyers.
Correct.
I'm guessing this is where the fireworks were, but was it just like good weather keeping insurance claims down?
Yeah.
Or something more?
This was the shockwave of the call, the financial services segment. You have to focus on this. Gross margin there surged, exploded really, to 55.6%.
55.6. Wow. What was it last year?
Just 21.8% a year ago.
Okay, hold on. That's a fundamental shift. Going from keeping 20 cents on the dollar to keeping over 55 cents. That completely changes the earnings profile of that business.
It absolutely does. And here's the critical point. Management stressed this wasn't just luck or weather. They were very clear. Well over half of that massive improvement, structural, permanent changes.
Structural how? What do they do?
They got aggressive, cut unprofitable insurance policies, really tightened up their underwriting standards, and just got much better at managing claims. Yes, less severe weather helped keep claims low, no doubt. But they attribute the majority of the gain to these internal fixes, things they control.
Okay. If that 50+% margin holds or even stays close, does that mean Cavco isn't just a cyclical home builder anymore? Does it start looking more like, a diversified company with this high margin, maybe sticky finance engine bolted on?
That's the core question, isn't it? That should be the takeaway. That's what the market needs to figure out. Is this sustainable? Because if it is, it changes the valuation story.
But they pulled this off while the actual housing market was doing some weird things.
Exactly. They've got this newly powerful finance arm, but the physical market, the homes themselves, showed what management called regional divergence. Big differences depending on where you looked.
Right. So let's talk about that. Where was it strong? Where was it weak?
Strength was definitely in the northern U.S. regions. Think Midwest, mountain states. Year-to-date shipments there were up double digits, solid demand. That really helped carry the overall volume.
Okay, but the South, different story.
Very different. They pointed specifically to softness in the Southeast. So Carolinas, Tennessee, down towards Louisiana. Shipments in that specific region were actually down 10% year over year in July and August.
So knowing the factory margins were flat, how did they stop that Southeast softness from becoming a big problem, like building up too much inventory? That requires being pretty nimble.
It does, and they were. They selectively slowed down production lines in those specific Southeast plants. They mentioned using extended downtime around the July 4th holiday, for instance.
Just tap the brakes where needed.
Exactly. But because the North was strong, they could shift focus, and overall capacity utilization actually ticked up slightly to about 75% from 70% last year. So efficient management across the system.
And they described the overall market as being in balance. Did the backlog numbers back that up?
Yeah, largely. Overall backlog held pretty steady at $210 million. That's about 5 to 7 weeks of production, which is seen as healthy, balanced, not too hot, not too cold.
Okay.
And importantly, management noted that even in the softer Southeast, those backlogs actually stabilized during the quarter. And then they started to edge up just a little bit near the end of October. Suggests the adjustments work, demand found a floor there.
And right after this strong quarter, they closed a pretty big acquisition, right? American Homestar.
Yes, literally just after quarter end. $190 million, all cash deal. Strategic pickup, adds 2 factories, and crucially, 19 retail locations.
Deepening that retail channel control again.
Exactly. Yeah. Especially in the South Central region. And it ties right back into that big strategy we talked about. Homestar historically sold something like 60% of its own factory output through its own retail stores.
So this deal immediately boosts CVCO's overall retail concentration, more high-margin channel sales.
Precisely. And management said the integration is already moving quickly and going very well.
Okay, let's pivot a bit. Investor context. What about headwinds? Clouds on the horizon. They mentioned commodity costs, tariffs.
Right. Always a factor in construction. The Q2 hit from tariffs was pretty small, maybe $2 million. But the risk is looking higher, mostly because of Canadian lumber duties.
What's happening there?
Well, they've jumped significantly from around 14.5% up to 35%, and now there's talk of another 10% hike on top of that. That's a potentially big hit to input costs down the line.
Any good news on the tariff front to offset that?
A little bit. The expected tariffs on Chinese electrical and plumbing parts got delayed. Management thinks that helps keep their total tariff exposure, for now, sort of the lower end of what they previously guided.
And we have to remember that lag, right? Between spot lumber prices and when it hits their costs.
Absolute key point. There's typically a 60 to 90-day lag. So the relatively low lumber prices we saw earlier in the year were still benefiting these Q2 margins. The impact of recent lumber price moves, or those higher duties, won't fully show up for another quarter or two.
Okay. On the plus side, any tailwinds? Regulatory stuff?
Yeah, the regulatory environment seems pretty constructive for the industry overall. HUD code updates allowing things like duplexes, fourplexes built in factories. That's positive.
But the big one everyone's watching is that chassis removal thing, right?
That's the one with the most buzz.
Yeah.
The legislation to allow manufactured homes to be installed without the permanent steel chassis in many cases.
Yeah.
The industry's really optimistic this could pass.
And if it does, what's the bottom line impact?
The estimate is it could save around $1,500 per floor. Per section, basically.
Yeah.
By cutting out that big chunk of steel.
$1,500 a floor. That's not trivial. That's like, taking the cost of a nice appliance package out of every home. Could really help affordability.
Huge potential impact on affordability, or potentially margin for the company, or some split.
Okay. And capital allocation. Looks like they kept buying back stock even with the Homestar deal.
They did. Pretty balanced approach. Bought back $36 million worth of shares in Q2. Still have about $142 million left on their authorization.
And still investing in their plants.
Yep. Ongoing modernization projects.
Okay.
Focused on safety, efficiency, getting more homes out the door. Plus, obviously, they deployed cash for the Homestar acquisition. So buybacks, internal investment, and M&A, touching all the bases.
Good overview. And finally, just quickly, the lending backdrop. Affordability is tied to mortgage rates.
Right. A little bit of relief there, maybe. Rates for manufactured housing loans have eased off their peaks slightly, down maybe 70 basis points over the last 3 months or so. Still high, mid-8s, maybe 8.5% range.
Still high, but better than peak.
A little better. And they mentioned seeing some appetite in the secondary market for these loans, especially from insurance companies looking for yield. But putting those deals together is apparently complex and kind of slow right now.
Okay, makes sense. So, pulling all that together from the call, it's time for our mandatory "This is not financial advice" segment. Based only on what we heard in the call, what's the outrageous, but maybe plausible
Yeah.
trade idea.
The trade idea really zeroes in on that financial services margin explosion, that 55.6% gross margin. It all hinges on whether you believe that's, mostly permanent, structural.
Not just a one-off lucky quarter with good weather.
Exactly. So the pitch is go long CVCO. The thesis is that the FS segment is now fundamentally a high margin machine. Let's say consistently 50% plus gross margins, thanks to those underwriting and claims changes they made. Less sensitive to weather swings than before.
So the outrageous part is fully buying into management's claim of a structural fix.
Right, believing it's not going back to 20%.
And the plausible part is the market hasn't caught up yet. It's still valuing CVCO like it's just the old cyclical flat margin factory builder.
That's the bet. The market is still anchored to the housing cycle, the factory margins, and it's massively underappreciating this potentially transformed high-margin recurring-ish finance business that could provide a real earnings floor.
So the trade is that the valuation multiple eventually expands as the market realizes the quality of these FS earnings, especially if they prove resilient over the next couple of quarters.
You got it. It's a bet on that structural change being real and the market eventually recognizing it, re-rating the stock.
Interesting angle. But again, folks, we are analysts breaking down a call. We are absolutely not investment advisors. So to wrap up, a really strong quarter for Cavco, driven by genuine operational skill managing production well in different regions, getting a good ASP mix.
Combined with that huge reshaping of the portfolio, cleaning up financial services, integrating Homestar to boost that retail channel, pretty impressive execution.
Definitely. So if we leave you with one final thought, building on all this.
Think about that potential chassis removal legislation. If that $1,500 per floor cost saving actually happens, how does Cavco play it?
Do they pass it all on to the buyer to juice demand and volume, make the homes even more affordable?
Or do they keep some, or maybe even most of it, as margin, boosting their own bottom line further? That decision could tell you a lot about their strategy and how they see the market ahead.
That's a great question to chew on. What would you do? Let us know your thoughts, share your research. We always like hearing from you.
And until next time,
we've taken the deep dive so you don't have to.
And the final reminder. Everything discussed here today is based on public information from the earnings call. It is analysis, it is commentary, it is absolutely not financial advice.